you want to have a blended fund. Like imagine what a family office would do. They're not going to go all in one on one asset class. It's not all in one on one business. Just split it up, be smart about it. The key themes of retail is there is a supply strangle. There is next to no shopping centres getting built. Construction costs are going up, and basically the rents aren't covering new construction costs once you water it out.
Most restaurants go out of business.
Exactly.
Most nightclubs and bars go out of business. They might have a moment in the sun, but eventually they fade and they fade quickly. So tell me about New Zealand quickly. What's going on there?
Everyone that thinks it's a totally different country when it comes to buying. Yeah, it's a different country, but like the buying process feels like you're buying in South Australia or WA. It doesn't matter. So I think it's the sleeping giant in the whole equation.
Oh, g'day, how you going? Phil Tarrant. Welcome to Inside Commercial Property for 2026. Back in the studio, out of the heat. Joined in the studio by Scott O'Neill, founder, Rethink Group. Scott, how you going? Good to see you, mate.
Welcome to 2026, mate. It's going to be a big year, I think.
You reckon?
Yeah, done a lot of reading and obviously seen the momentum of last year really build up. We've got hundreds of buyers waiting for properties at this minute, like active buyers, hundreds, several hundred. But we do buy sort of 65 to 70 deals a month at the moment. Yeah, they're out there. It's just a matter of getting through the backlog. And the good thing is there's a lot of overlaps in those kind of entry-level price points. So if you're an investor sub 2 million, yeah, it can be a bit of a wait, but you're waiting for the quality. Yeah, if you've got higher budgets, there are deals out there. And I think there'll be a bit more liquidity in this market too. Yeah, I'm just excited. I think it'll be a big year.
So I'm a buyer this year and we've been sort of swapping notes over 2025, 26 holidays, and you'll probably see pretty quickly that I'm probably one of the worst clients around because I go down a pathway and then get busy and then sort of stop doing. You must see that a lot with a lot of people. So you're not alone. It's me as well. It's not that focused, but
I remember, what was it, 4 years ago dealing with you. You were the most disinterested buyer of all time. It was
is that bad?
It was from a pure admin point of view, terrible. Couldn't get you.
Fair enough.
But you were good at making the decisions. I think we looked at 3 or 4 deals. You just wanted, a strong opinion on which one. I just said the pros and cons at the time. You make the call. You have to make the call. I'm not going to do it for you, but you sort of still delegated as much as you could in that department, which I get. Yeah. But it worked out.
Yeah.
I'm
probably one of the worst clients around now. I know enough to probably be annoying, and I'm very conscious of that. So I've got to try and contain that when I'm buying property, but it's always a challenge when I get the chance to work with professionals across it. But we had a really good podcast back end of last year, 2025 at the Royal Motor, what was it? Royal Motor Yacht Club, was it?
Yeah, that fancy joint.
But that was an opportunity for us to debrief on the year that had passed, and we reflected on a lot of our predictions that we made in January 2025 and sort of got our score sheet out and worked out whether or not we'd done a pretty reasonable job or not. Great feedback on that. If you haven't yet tuned into that podcast, so I'd highly recommend you go and do that. Potentially press pause now and go and listen to that because you get a sense for how we sort of bookend the year. At the start of the year, we'll give some predictions and insights and sentiments around property investment over the coming 12 months. And then at the end of the year, we'll debrief on that and see how we've gone with it. So that's very much the focus of this podcast here in January of 2026. We're going to get stuck into the way we see the world, the way Scott sees the world for the coming year, where to put smart money for capital growth right now, areas to avoid, asset classes to invest in, and some of the key themes moving forward. But probably, Scott, you've been more absorbed, not with property over the summer, probably more so around the cricket. I know you're a bit of a cricket tragic.
Yeah.
You happy with the result?
Yeah, it was good.
Yeah.
It's good to see a couple of the last game go of more than 3 days. We spent the day up with clients in Brisbane. Yeah. That was fun.
I think I saw you on that. I think that final podcast of 2025 was the day after that, and I think you're still a bit
it was a little dusty.
Ginger.
You got to live life, and it was good to catch up with all the clients. And it's a long day though, isn't it? It was hot.
Did you get out to SCG at all for the game?
No, we just caught up in a local pub and did that. I think one day going there's enough for me. I prefer it on the TV, the cricket.
A lot more.
Yeah.
Can you give me some sort of analogy which puts, a good cricket analogy relevant to commercial property investing?
Well, look, I'd say it's not a cricket analogy, it's a sports analogy. The market's in pretty good form at the moment. I think we've got an industry that's kind of getting more and more attention. There is like, these are really high level key themes. There's not much development happening. There's more investors. There's a lot more liquidity happening. So banks are lending more. There's foreign money coming into Australia. There's a search for yield happening at the moment. Confidence in property itself is as high as I've seen it for a long time, both resi and commercial. Like, why are you investing this year? Like, this is a good question, because what you're going through is probably what, 80% of people out there feel like. You've been on the sidelines, you could have invested, but why this year for you? When you
I don't know, because I say at the start of every year and I typically don't do a lot. I don't know. It's probably because I should do.
Yeah.
Okay. And probably have to.
And that's a theme.
It's certainly around making sure I'm deploying my capital in the right way for the immediacy of returns today, but for a long-term sort of sense for wealth creation, right? I'm very conscious of the fact that I probably sometimes miss the mark in terms of not taking action. So no doubt a lot of your client base would feel the same way with it. Hence the reason why the start of the year is when everyone goes, oh, this year I'm going to start doing this. And it's just, I can do it. I've got capital, but I've got to you got to do the work. Like you've got to do the work, right? You've got to do the pre-approvals, you got to do all the financing, you got to do everything, right? Yeah. And sometimes you sit there and just go, oh, it takes a backseat.
It's a lot of work. But yeah, that's such a good theme, to be honest. Like, you have to do it.
Got to do the work.
It's taking action is like, it's the biggest part of it. Like, there's so many people that get caught up. Like, is this the right market at the right time? Like, getting too granular on this asset class.
All irrelevant.
100%. Like, we'll talk later about like interest rates. Who cares if it goes up 0.25% or down 2.5%? Like, what's the average over the next 20 years going to be? No one knows. But building is going to go up in terms of building construction costs. Population will increase. You've got the dollar devaluing forever. So you've got to have a fixed asset that's relatively stable in nature. And property's kind of proven that over the years. Like, even in the GFC, it dropped less than 10%, and it took 9 months for the total recovery to happen in Sydney, for example. And that was the worst economic shock in the last 15, 16 years.
Yeah. No doubt a lot of your clients sort of have this sense. It's really, and you set out, how do you go about creating wealth right through property? How and maybe it's a question for you and your client base, how much capital do you retain to have buffers versus how much do you deploy to create wealth? And everyone's a horses for courses type thing. But, I imagine a lot of your client base would sit there and just think, well, I've got the family home paid off. I've got multiple investment properties with very little debt on it. Is that enough? Or, should I actually be always up to 80% debt levels and deploying capital all the time, right? It's a philosophical thing.
Yeah. Or once you get to a certain level, that 80% rule's completely dangerous in a way. Like, but you got to do it for a while. Like, as you're starting, leverage up. You got to make sure your interest is covered, plan for some downside. That's what, the resi market's famous for. Like, you can use 10, 20% deposits, stretch it out, do quite well. But you want to get into the pattern where you're talking, which is this comfortable zone where you don't have to invest. You're not freaking out if it doesn't grow one year. You got the cash flow. I've been lucky enough to be in that position for quite a while where I don't look at the portfolio value at all. It's actually not even of interest. I used to be interested, like counting it up, go, that, like, it's a vanity metric, it's gone up that feels good. I'm worth X amount. But now it's, there's a safety net there. That's all it is. If you add to it, it's a safety net that's slightly bigger with an extra admin point or two. But the key is kind of just allocating your funds into the best assets, essentially. So things that are going to be safe, long-term security, low touch points, and then you literally hold it for the rest of your life.
Yeah. You probably see in your client base, and maybe you do this yourself, and it's certainly how I see it, is sort of this compartmentalized capital allocation concept where you just go, okay, I'll compartmentalize this money in these properties and this setup over there, and that just stays it is. And that might be, a principal place of residence or a certain portfolio you've had for a while, and you go, I'm just going to put that over there. I'm not going to touch it. I'm just going to leave whatever equity's in there and leave it alone. You compartmentalize it out, and then you might have that 2 or 3 different times where you go, this particular portfolio, I'm happy to milk it and work it. So you're still doing what you're probably doing early in your investing career, and redlining maybe at 80 or 90% with a compartmentalized, packet of investments, but you've still got your year de-risking strategy elsewhere. Is that a typical thing for people to do?
Yeah, to a degree. There's many different ways to split it up. I've seen, like, I'll just use my example. Like, you feel a little bit light on in industrial, just your next deal has got to be industrial, or you're, like I've spoken to you want retail. That's your next move, something multi-tenant. You don't need to get too scientific on it, because anyone that gets that granular has got to realize that there's too many variables at play. No one knows what's going to happen for 20 years. Like, just apply the common sense test to it. Like, don't get too bogged down, but just, you want to have a blended fund. Like, invest like what I would say, like, imagine what a family office would do. They're getting paid professionals to manage. They're not going to go all in one on one asset class. It's not all in one on one business. It's not all in one on one commercial deal, unless they have a great business that's ticking over every year, that's recession proof. They're not going to go 20 houses, which would be classed as an overextension into that market. Like, just split it up, be smart about it. Be open-minded to any deal as well. Like, you might find the best office deal ever, because it's 50% under market value. Sure, the market's terrible in certain areas, but if it all adds up, it's an opportunity worth looking at.
Yeah, so be pragmatic, while also strategic.
Of course.
That's the balance. That's the key thing. So in terms of a holistic view for 2026, Scott, and an outlook, how are you going to define this year? And you're going to remember, we're going to sit down in 12 months' time and go back on this. So give me a sense, give me 2 or 3 or 4 headline themes for 2026 as an outlook.
Yeah, so the themes that I'm going to be predicting is, one, building supply is going to be very difficult. So it's essentially the cost. We'll go into these a little bit later, but yeah, basically not much development in commercial. So supply is constrained. Next one, private capital is diversifying beyond just the traditional industrial and retail. They're looking at childcares more so. That I'm seeing that massively in our business, because again, we represent a large portion of the private investors in the current market, and they're pretty open to a little bit of everything. There's offshore capital coming back in droves at the moment, so that's going to do all sorts of things to the probably top end of the market. Theme 4, interest rates. Like, we'll go into that a little bit later, what's going to happen with that and the effect on the market. And yeah, I guess one of the most important things we'll go into is our predictions for each asset classes. So if there's one snippet of this podcast series you want to listen to, just based on our last few years of getting it right, we're not going to be exact, but we've been pretty exact, to be honest. But I'll tell you what I think the money is going to be increasing at certain percentages in different asset classes. So we'll break down the office market, retail, industrial, even go into things like childcare. So, and just finish up with what deals would you not touch in 2026 as well?
Okay. Well, let's start with asset class, because that's what people like. And often if you're going to listen to one podcast this year and one bit of it, if you're looking to deploy capital, I'd say this next sort of 20 minutes discussion is certainly relevant to you. Where do you want to kick off, Scott? Industrial?
Yeah, so I was really thinking which asset class will perform the best this year.
Yeah.
It's going to be a nail biter. It's going to be out of retail or industrial. I called retail in 2025. My logic was the yields were good. They were too good. People overestimated the risk from, the old COVID days, and it was just priced well. But if you look at industrial, like the prime average yields now are around 6.1%. 2024, they were down at 5.4%. So it's quite large yield expansion, and there's still rental growth as well. So remember, yield is a good indication it's one of the most important indications of value, because investors need a return on their money. So when that yield gets a bit better, it implies there's either higher risk, or if you're really within the market, you might see that yield is a little bit off where it should be. I think it's off at the moment. So you're going to see good growth rates in industrial or prime and secondary. My prediction is 6 to 9% capital growth. There's a range because it's Australia. Like, how can we generalize? But you're going to see certain subsectors of the market do 15+%. Some may not grow at all because there's little pockets of oversupply. But overall, it's going to be a good market. It's off the back of a pretty strong 2025, but it's going to get stronger, I think. Remember, yields were as low as 4.5% for prime back in the peak, which is mid-2022. So now you're at 6 odd percent. That's strong value. And we'll talk about interest rates or whatnot, but that's going to attract capital for sure. Yeah, and I think private investors are going to be aggressively targeting secondary industrial. So that's a theme we've been talking about for many years. The replacement cost.
So define secondary industrial again.
So it's basically cheaper investments. It's the tin sheds. It's the 20-year-old stock. It's sub 5,000 square meter warehouses that are a little bit older, maybe freehold. It's what most private investors would be looking at. So secondary stock is generally cheaper per square meter because of its age, or it's got a small lease on it. But the beauty with that market is the owner-occupiers are going strong. So even if you lose a tenant, the value is underpinned by the shed itself, the square meter rate, and owner-occupiers are going pretty hard at it. We've said this many times on the podcast. The reason they want to buy is they're scared of rental growth. Rental growth is still happening. It's slowing down though. I've spoken to a lot of industrial leasing managers. It is getting a bit slower from a leasing point of view. Vacancy rates are getting a little bit higher in some areas. So that's kind of going to bring it down to earth a little bit after all the capital growth.
Okay, so industrial is relevant for the spectrum of investors, from smaller first-time investors in commercial, maybe buying small industrial lots, all the way through to family office type stuff.
Yeah, and you're going to hear me bang on about this all the time. Just make sure there's a minimum yield target. There's a lot of people in the industry, sales agents, professionals, whatever, that will try and encourage you to accept lower yields. If you do that, that whole advantage of growth and the yield valuation I just mentioned is out the window.
So how do you set a minimum yield target for industrial?
Look, it's going to be case by case, but if you're going much further under like 5.5% in the current interest rate, there's got to be a very good reason for it.
Like fully net, triple
net. Yeah. So 5.5. Look, if you're taking a 5.25, it might be there's a 15-year lease with 5% increases in it per annum, or there's 20% upside in 3 years' time. But if you go and buy a blunt 5% net yield asset, you're just going to underperform. Simple as that. It might be safe, but you are not going to be getting the returns the good investors will be getting.
So this is this concept of you might be deploying your capital and getting a reasonable return on it, but you really want to be overperforming on the return of capital that you're putting into commercial investment.
Yeah. Well, everything we're about is trying to outperform the market.
Yeah.
Otherwise, just go buy an index fund.
Yeah.
Boring. But this is a leveraged investment. Hopefully you outperform the market. We have a focus on yield and growth. The combination of those two is how you get a very good return on equity.
And is it chasing alpha? Is it harder today than what it was 3-4 years ago?
It doesn't look. It feels more difficult, but it's not, for a few different reasons. But mostly just because the buyers are more educated. So we would present, like, if the buyers we had today and we brought them back in time 3 years ago, it'd be gold. Yeah. Back then, people were a little bit kind of finding their feet more. They needed higher yields to justify it. It's still a fairly balanced market in some areas, which brings me on to retail.
Yeah.
Number 2, I'm predicting 5 to 8% capital growth. So slightly less, but almost the same. The key themes of retail is there's a supply strangle. There is next to no shopping centers getting built across the country. There's a couple of big private equity type jobs and stuff like that, but over 27 million people in Australia. It was 26 a few years ago. There's construction costs are going up, and basically the rents aren't covering new construction costs once you water it out. So no new supply is happening. That is a problem for the next 3 to 5 years. So if you can get into a well-priced per square meter at retail center that's got a good trading history, even if you have a vacancy or two over that period, you've got a good 3 to 5 year period, because the whole, build costs versus valuations on market, it's going to be out of whack for quite a while. So
why, if the economics don't work to build more shopping centers, why would people therefore be selling shopping centers?
Good question. So I literally, an hour before this meeting, I caught up with one of the largest leasing managers in the country who also owns a selling department. And they're like, I just can't get stock. Especially because retail's had a good 2025. Vendors have had a taste of the growth.
Yeah.
So they now know it's an upward swing. So the logic is, let's just hold on for a little bit longer. We'll get more growth. Why people sell? It's just the old things like death, divorce, all that kind of stuff. There's fund managers that are cycling out of their 5 to 7 year hold periods. There's some people just get for lack of a better word, the shits with the investment because they have a bad manager. I've had a couple of those last year
They just
where
got done with it and want out.
yeah, property managers just did a terrible job on a deal and a vacancy or two pops up and they go, oh, it's a dead investment.
Yeah.
I'm going to sell it. And there's always a buyer at the right price. So stock is hard because people are pretty comfortable with the essential service model. Like, you know, things like supermarkets, chemists, medical, like it's good for the long-term hold you mentioned. You're looking to allocate capital. You're going to feel pretty good about a multi-tenant investment, freehold, good market, whether it's major regional, like that's good 20-year hold.
What do you need to get sort of a good multi-tenant freehold? What sort of dough do you need to get into that sort of market? Because I'm conscious here, like for a lot of people, retail, a lot of people might think, oh, it's just one shop somewhere.
No.
It might be in a strata complex or something like that.
Yep.
What we're talking about is freehold. What does that look like? What does it cost?
Yeah, look, freehold, it does vary massively. Like my first freehold shopping centre was bought 2018. I paid 3.9 mil for it. That same deal is probably 7.5 to, I wouldn't say 8 mil, but that's how much growth is happening with this stuff, you know.
And the growth is driven through rising rents
and cap rate compression and all of the above. It all kind of washes into it. But to answer your question, look, if you got 5 mil, so let's say 30% of that plus 5% for costs will be enough to get in. You'll get the odd smaller deal as well. Like, you know, something we're seeing a lot more is investors jumping in together and doing JVs or getting 3 mates together. And, you know, let's say you were going to spend 5 mil and you had 2 mates that were going to do the same thing. I'd rather 1/3 of a 15 mil centre any day because then you've got your big ticket tenants like on the 15-year leases. You're in a whatever market you want to be in. So there's a lot of people pairing up. There'll be plenty of that happening this year. So, you know, even I'm working with one of your accountants that does a lot of the structuring for that. It's been quite popular. He's doing these deals all the time. That's a way of just kind of getting into a better deal.
Really, yeah.
And
so have you got 5 million for like a freehold, multi-tenanted retail purchase? There you're talking about what, small regional type stuff? Is that what you're getting?
Yeah. So, not small retail. It could be Sunshine Coast, could be Central Coast, those types of fringe cities, but it's more size dependent. Because a shopping centre in a regional area, if anything, they're probably more valuable long term because there's less chance of development happening. If you're buying in the middle of a urban sprawl in Western Sydney, there's chances new shopping centres can get popped up just to deal with the next housing estate. Once they're all built and no new housing estates, like you're the only shopping centre in that area. Well, you know, there might be a set of 3 or 4 within a 5K radius, and that's its critical mass. There's no room like for another development. So you can feel safe that supply will be constrained, and that's the theme. And there'll be yield compression because that's the other part why I think there's going to be a good year for retail, because more investors are targeting limited stock like yourself. You know, it's a good investment. I bought a few of those myself over the years, and they're good deals to hold. Like there's legwork in it. Like you've got the odd vacancy and got to do maintenance here or there, but they're all in one portfolios, and people spending that type of dough like that.
And give us a sense for cash flow constraints around these type of assets. If you're borrowing at 70% at $5 million, your tenancies, what sort of negative, positive cash flow are you getting on these things, or they're largely self-sustainable?
Oh no, they'll be positively geared. Like if you're using a cash deposit, you know, like you put 5 million, you're getting 6% of that, that's 300K. So you just minus, that's 300K net. That's after management. That's after land tax. So that's something a lot of people forget when they look at resi. So you're getting a true, that's 6% net. You might get 6.5. That's better. So then you just got to take your mortgage off that. So, you know, you're taking 70% of 5 mil, you know, you do the math, you're well ahead. You know,
and it's the point, right? You know, so a lot of these times, these investments just because of the nature of commercial investing versus resi and benefits of a lot of the cost to keep the properties covered by the tenant. You just need the capital to invest. That's why the selection of the asset is so important.
Exactly. And again, think I'm going to pass this on to my kids. You know, I'm going to pass it. Like this is something you don't sell. It kind of changes how you behave, but you've got to get that initial price because you don't want to give away 5 years of capital growth because you were silly on the negotiation side. Because if you do that, you valuations, again, I was talking to another agent saying there's people that kind of just, they got FOMO and they're just paying more, and then the valuation doesn't stack up. Yeah. And then you're just crashing, and you spent 10 grand on DD and legals and all that stuff too. So yeah, you want to strike, but still at the right price.
So how do you know if your buyer's agent's putting a good retail asset in front of you? How would you measure that really quickly?
Comparable sales. So you want to get the same market yield or better. Like if, let's say we're looking at like old Coles or Woolies Centre. Like this is like, with the capital fund we've got now, we're doing these bigger deals. You can get those at say 6.5% net. They were selling at 5.5 a few years ago, even below that. It was a great deal at 5.5. Would you buy it? Probably not, because I know there's the odd deal out there at 6.5, and that's an easy way to value. And then you've got to look at the age of the asset. There's extra maintenance or less depreciation because, your after-tax yield will get affected. The newer deals will give you more back in your pocket. But yeah, your gut's quite right as well. Like, anyone that's buying would see all the ads and stuff like that, what's out there. And if you feel like the yield is thereabouts, then yeah, that's it. Just don't sacrifice just because you fall in love with the deal, because that's how that's how you just get poor returns for the next 5 years.
And let's talk about office. As you mentioned, it's sort of been a little bit on the wane, not that attractive with investors. Now, there's still this concept of, with commercial property, that we're in this sort of pre-boom type phase. And I imagine you would say that sort of period's ending pretty quickly, but we're going to see any of that in the office market?
Yeah. So I don't want to linger on office too much because no one actually in our circles buys the CBD office, that is. Yeah. But it's still pretty fascinating when you look at it. So high level, I'm predicting there's a big range here, negative 5% growth to 6% growth. Negative. So 5% falls up to 6%.
And this is prime Sydney, Melbourne, Brisbane.
Prime will grow like your 6%, secondary -5 or worse in some subsectors. Wow. Fun facts, like worst market in Australia right now is Melbourne secondary, sitting at 21% vacancy rates. Worst in the world is San Francisco in the US at 34.4%. They were at their peak vacancy rate 3 years ago at 37%. So it's not falling. It's basically been that terrible for quite a few years. So there are structural issues in many of the office markets, but talking about the best office markets in Australia, Canberra and Brisbane, sitting at 10.7% vacancy. So it's still up there, but it's a lot better than it was. The best in the world is Tokyo at 1% and Seoul is number 2 at 2%.
So is this just now for office markets in these locations, wait until the population increases to absorb the space? Because structurally, I can't see anything really changing to accelerate a spike in leases for office.
No, and that's why like office growth rates are quite subdued at the moment. So, I don't love the CBD office space. Like vacancy rates, even for retail, are above 10% in CBDs. Like, Australia's kind of almost lazy in its office market, where it's something that will recover in time through population growth, change in work habits, and you see it happening. But like we're in the city CBD right now, it looks busier, but the offices are still half empty, it feels, and people aren't here all the time like they were. So other countries, like we all know the work ethic of the Japanese and stuff like that. Culturally, it's very different. And interesting, like just to show you how much a vacancy rate affects how fast rents grow, because the tighter the vacancy rate, the quicker rents grow. So Tokyo, the last 4 quarters annualized, have done 30% rental growth for CBD office.
Okay.
And they're selling at 3% net yields, 3.1, 3.2. So you can go into Sydney and get 6, 7%, but you're just not going to get the rent growth because you've got this leasing risk, and that's what's priced in. So remember, yield, the higher it is, can be extra risk. Even though the yields, you could probably get an 8% in Sydney. I just still, because I know it's a risky 8%. There's lower risk 8% out there.
So what would it take for a deal to stack up in office for you to put it in front of your clients?
Way below replacement cost, number 2. You need strong lease covenants that can get you through the next 5 years. You would need a building young enough to not need to be replaced or completely decked out, because like fit out costs through the roof. That it costs a lot to refurb. You're up against prime office getting built too. So like, if you're too far away from that A grade stock, it's just not tenant friendly. So you don't want to be left in the situation where, like, talking these big buildings, spending 100 mil plus just to get it back to where it was. I always think, like, it's like building a granny flat when you could just buy another bit of land somewhere else. So I really want to reinvest all my capital into this old deal, or buy another deal somewhere else and get more land and play around with that new rental income. Yeah, so you wouldn't want to have to spend much on it because it will blow out. And then you're still not going to compete with the brand new stuff. So there's a lot of fund managers out there now trying to position high yielding office because it looks good on a pamphlet. It's not something I'd put my name to.
And you think you're going to get transitional stuff, or maybe it's more of an insto play or even sort of larger family office play where people are converting office in a sort of city CBD office towers in the resi. Is that going to be a theme moving forward?
Yeah, look, there's student accommodation options, there's, hospitality options like that. But yeah, it's just not getting done because of the construction cost thing. It's probably cheaper just to start from scratch and build a premium product in the resi space. So yeah, look, I haven't seen huge amounts of it. It's, again, that's super fund level expenditure type range. But yeah, the everyday investor, like offices, like you can still do very well if you're targeting the classic suburban stuff where you might have the lawyer, the medical, like we always bring it up on podcasts because we talk about all this doom and gloom around office, but I don't want you to think it's every office. Yeah. So I always got to repeat that. So
you think about like a satellite CBD in Sydney or Brisbane, which might have the dentist, the doctor, the lawyer, the accountant, like that stuff's still okay to consider?
Yeah. And like anywhere in Southeast Queensland's looking pretty strong. Like, all the stuff that's coming up there, like there's a lifestyle movement there. It's Canberra's pretty strong randomly, but it's been stronger in the past. So it's not as good as it once was. But yeah, it's just diversifying. A lot of investors, you might have a heap of industrial, heap of retail, then maybe you can afford to go a little bit more counter-cyclical and try go a super high yielding, riskier upside investment office space. But each to their own.
Each to their own. There we go. Now let's have a look in further detail the key themes. I think you mentioned at the top end, supply, private capital, diversification, more offshore dollars coming in, and interest rate stability. We'll kick off with supply, which is sort of consistent with the chat we've just had. How do you see that playing out across those three asset classes?
Basically, where rents are in the market, it can't generate a profit for a new, like, build to rent scheme. Someone's building for a future tenant to lease at that rate and then to use that rate back to sell to an investor. Long story short, basically it's costing too much to build versus what existing stock is. So existing stock is more valuable because of it, because there's no threat of new supply coming online. The only place threat is there right now is small warehouses, where you can buy a big warehouse and chop it up and sell it to a inflated price to small investors. And you're seeing it in many parts of the country. I always use the example, like you can pretty much double the square meter rate by just chopping it up and just putting it, it doesn't double the construction cost. So that's why it can make it work. But then you get into the theme where they build too much too quick, and that creates a bit of a vacancy risk short term until it gets absorbed. Shopping centers, they're not building any. Office, unless it's super premium, you would have seen it close to where you are. They get them out of the ground. But yeah, no one's building things that, unless it's pretty premium at the moment. So if you sort of fly under the radar of that super premium market, again, you got that 3 to 5 year window where there's not much threat. So I feel good deploying my capital in markets like this because I'm not scared of developers building properties that are better than my existing stock at a cheap price. They're way over. So tenants aren't going to move and pay 40% extra rent somewhere else, like, because the quality of the building is probably not 40% better, especially if you're talking warehouses, and they don't even care as long as it doesn't leak sometimes and it's a good location. It's a good thing. So key theme number one, not much development happening. So existing stock will grow. Theme two. Sorry,
just on theme one then, from a defensive play, to your point around deploying capital, and you've got a window 3 to 5 years as a result of constraints in development and the economics don't work. Your fallback position is that if you deploy your capital, you can extract it if you need to because there's other buyers there.
Yeah. So let's say like the markets boom. Let's say they absolutely boom. I don't think they will. We're talking single digit growth rates here. They might. So, but if they did, that means developers can get in. So parts of the eastern suburbs, it works because they can sell things for tens of thousands of dollars per square meter. You know, I've heard office selling at $45,000 a square meter in some buildings, like crazy numbers. So that means they build and that creates supply, and then that will slow the growth down. So it's just the economics of it. If there's rapid growth, it will slow down in time. But the 5-year window is like where the economic rent is versus what it costs. It's just there's sheep stations between it, which is good for us investors.
So the defensive posture, if everything goes wrong, is that you can extract yourself from it and you'll get your dough back and some.
Based on that theory, for sure. So unless there's a massive spike in interest rates or some
other black swan event.
Exactly. But even when those events happen, like people kind of just sit on their property, because you've got to remember it's a low debt world.
Yeah.
You know, you will go in with debt at 60-65% day one.
Yeah.
But after 5 years, you're probably sitting at half that. You might pay it off in that time. Who knows? So a lot of these owners don't have debt. That just means they just sit on it. They don't care if it goes vacant. Of course they do, but it's not. They're not knee-jerking a sale.
Yeah.
Like these are professional investors. It's a wholesale investor world where they've probably got a lot of other assets like stocks that they can quickly get out for liquidity to sort out urgent bills or whatnot. You're not paying an urgent bill with a commercial property.
No, someone else is paying the bills.
That's your war chest.
You just got to cover your mortgage.
Yeah.
Good. All right. Private capital diversification.
Yeah. So this is a big one. Private capital, like this is obviously my world, dealing with all the private investors. They're going to be looking outside the traditional assets, which, if I'm naming three, it would be industrial warehouse, neighbourhood retail, and that kind of freehold suburban office. They're the big three. The new hotspots are going to be childcares, large format retail, medical suites, specialty assets like cold storage, which is basically industrial, slightly higher square meter rates. So the reason people are flying to these kind of other assets is things like longer leases. Like, even though things are feeling pretty good from our point of view in terms of where interest rates are, where supply is, like there's still negative sentiment in the air. Like there's always something going on, and the threat of war seems to increase daily. There's a lot of rhetoric out there that makes you feel nervous. So that kind of makes you go towards long-term safe investments that don't have much going on with them. So that's where your large format retail, which was the best performing asset class last year.
You just define that again for people that might not be familiar with large format retail. I'm sure they've been to one of these shops.
Yeah. So just big box retail, things like selling electronics, beds, Bunnings is one of those. You've got all the car type places like super cheap autos, Pet Barn, like they're big Australian brands. A lot of them are listed. They're basically a big warehouse with signage opportunity that customers can walk in, and there's a bit of aircon in it if you're lucky. So they're basically retail, but they're quasi in between, and that's they're good because they're big and they're expensive to build, and their rent is pretty cheap per square meter. Like where a market might be $600 a square meter for normal retail, large format retail in that same area, because it's larger and less efficient, would be $300 a square meter. So it's half the price per square meter. Industrial in that same market might be $180. So industrial's cheaper again. So I just like the idea of the large size of it, pretty cheap. And they're not building enough of this stuff. And
so what's sort of an entrance cost to, say, a large format retail in, not in a CBD, but like a large sort of satellite like area like a Wollongong or a Newcastle or a Central Coast or whatever equivalent to it? Like, what's your entrance cost into something that's got 4 or 5 large format? Might have a super cheap and a barbecues galore and maybe a El Jana chicken joint out the front or something.
So single tenant investments probably like 2.5, 3 mil. Like that'll get one of them, and then if you've got a centre with 3 of those, it's just 3 times that price. So we did 2 of the cheapest Bunnings in Australia last year, like, around the 10, 11 mil mark as well. But they go up to 50 plus mil, as you know, the big ones. So they're out there. Like a centre it's a good deal. There's expert tenant negotiations needed on them, because you're dealing with the likes of, Woolworths or Harvey Norman, and you got to know what you're doing there. So have a good manager. They'll play every game under the sun. That's the negative side that not many people will tell you about.
Tricks.
Yeah.
Yeah.
And you'll get held to ransom to say, we're going to leave and all that. It's funny, they all say the same thing every time. I've seen it 15, 20 times and I'm like, oh, here we go again. They're just playing their playbook and the client's freaking out saying, oh, I've got to lose my tenant, and just show them what they've said on the last 3.
Yeah.
So yeah, never just look at the fundamentals. Where are they going to move? Is that business going to, if they leave, would a competitor move in and take their market share? Sort of.
So you can buy these either in a strata arrangement and or full freehold, right?
There's nothing wrong with strata too for these because they're still big spaces and strata is simple. It's like common building insurance, maybe some driveway maintenance.
Like so the management is, whether it's strata or, I imagine the management is more significant on these large format retail. If it's you own, the lot of it in a freehold, right? You've got a lot more responsibility. You have to do the gardens, you have to do the lawns, you have to make sure all the car parks are right. But
like I'd even say, like if you're playing with say 5 mil and you're looking at small shopping center, there's a genuine argument. Would I want to deal with a little butcher, a pharmacy, and 2 foodies and 6 or 7 different little tenants in a 30-year-old building, or do you just buy 1 or 2 prime stratas on a decent yield with 10, even 5-year leases? Like you're too, like I know you would enjoy holding that, but your mindset will go, I want neighborhood shopping center because that's what everyone does. Yeah. It's kind of more familiar. But the big box like large format stuff is smooth.
Does it come up very often? Good quality stock strated with big box retail?
Not often. They're hotly contested. So the trouble with that asset class is those in the know it's good, so the yields are sharp. Yeah. Because you are dealing with like childcare level security. Long lease. It's all, you got the 4. Like one of them we bought had CPI increases plus 4% in it. Like that was the best lease I ever saw. And like I remember when it was 10% rental growth.
Who signed that? A large ASX listed company?
Yeah.
Okay. Cool.
Yeah, just crazy numbers. There was no ratchet clause in there or anything like that. But yeah, there's all sorts of wacky things in there. I think they started at a lower rate, but like it's over the course of 5 years, it threw it up quite to a large number. And the clients made a lot of growth off the back of that, obviously.
So they just got structural annual growth. Whenever that resets again, they get, CPI plus 4%. So their investment is just compounded.
But that's a once off. So most of them are just 4% or 3% or CPI only, like, or the greater of. So, but either way, it's kind of banked in growth. And, if you're getting a decent day 1 yield and they've never missed a rent payment and there's next to zero chance they'll leave, it's probably a good deal.
So give me a sense for the relationship between, whether it's big box retail or whatever, the relationship between structural increases to annual rents married with other capital growth metrics. So if you're getting a 4% uplift in rents every year, does that inherently mean that your asset is going up by 4% a year, or is going up more than the 4%? Because it's 4% on the rents and then maybe other drivers which are contributing.
Well, it compounds. So if you're just looking purely at rental growth and the same cap rate, it's 4% compounding. So you extrapolate that over a 10-year period, it's pretty good growth.
So it doubles on that basis, whatever.
Yeah.
Every 7 or 8 years with a big
what is it? Like you need to calculate. But let's say it grows by 48% in that period. That's your $1 million investment's now worth just under 1.5. And that's nothing. But what if the cap rate went from 7 to 6%?
Yeah.
Huge. Like, there's another 12, 13, 14% upside on that. Yeah. And then you're getting the cash flow every year as well. You're positively geared, remember. So you add all those up together, it's a really good return on equity. It might actually increase your lending capacity too. So then you could have done other things on the side, or you reinvested that capital somewhere else that's more upside. It just all adds up to a larger kitty at the end of the day compared to just evenly gearing something or negatively gearing, which is what everyone does, because they're missing out on all these opportunities of reinvestment, comfortable living, better lending conditions for you. Like you'll get better interest rates if you're not redlining as well, because you can shop around to 4 different banks and they want your business, not because you have to have it. So it all changes the scenario.
Just on that basis, before we get to the next theme, we know that APRA has put in place these recommendations, regulations around high DTI loans. So they're trying to curb investors from debt to income ratios. It doesn't, commercial doesn't fall into that bucket. Are you therefore seeing any accelerants in commercial because it's not contingent to these DTI things? Like you might be capped out resi, but
It's a good point. And I know why you're saying it. we haven't seen it mostly because that's been the entry-level investors in the resi market played that game. Where I saw it was like it's an equivalent question. 2018, the Bank Royal Commission made lending much more difficult for everyday people. We saw a spike in commercial investment because basically it was less attractive to invest in residential. So the less attractive it is for residential, the more attractive it is for commercial if it's anything to do with cash flow or difficult lending, stuff like that. Because, I think that's just going to push more people this way mathematically.
Because I think also around that DTI stuff, what falls outside of it is sort of construction as well. So, if you might be capped out resi with DTI lending on APRA, but if you're building, it's different again. So these are the nuances you'll start to see as markets evolve and change and lending regulations evolve. Let's chat about offshore dough coming in. Give us a sense for 2026.
Yeah, so like I mentioned about those two Asian markets, so, the average yield in Tokyo is around 3.1, 3.2 for office. Seoul, South Korea is around 4. Sydney is 6. Yeah. So the yield's high for Australia. We're relatively high for our risk assessment. So foreign investors see that as an opportunity. So they are deploying capital. New Zealand's definitely in that bucket. So a lot of Singaporean capital, a lot from the UAE, a lot from the US as well. So the more turmoil overseas, the kind of encourages those people that just need to protect their money to come to places like Australia.
Are these private investors or is this sort of more institutional stuff? So they're playing a different...
They're playing the currency game too. Like, the Australian dollar's weak, so they might have a win there. They've been pretty dormant of late. Like, remember a few years ago how the amount of Chinese investors, or like they're not there at the same levels as well. So it's coming off a low base, but yields are about 200 to 300 basis points better than US and Europe.
And they're just looking for return. So they'd be buying assets in multiple tens, if not hundreds, right? So the average Aussie commercial investor isn't really competing with offshore money.
No, correct. So they'll compete with your fund managers. So it's going to make their game harder, but that has a flow-on effect. Yeah. Because if the yields are tighter, then, it does trickle down, but they do perform differently because we're not up against 3 or 4 different foreign buyers on deals. Like we're up against private investors from Australia. That's it.
Yeah.
Like maybe an owner-occupier here. So, capital will flood back. That's going to increase the demand, which kind of like leads in a little bit theme number 4, interest rate. So I remember like last year, I had 3 or 4 different media outlets commenting. They wanted me to say, why is commercial going to be a bad investment because interest rates are going through the roof? I'm like, what just happened? One data set happened and everyone's freaking out and wanting to make stories about it. Like it was just for this 1 week. They were desperate to get negative news stories.
How often maybe it's deliberate to you, but do you get sort of, maybe they're just ill-informed journalists, but loaded questions so they can get a soundbite, like trying to...
They wanted a negative story for interest rates last year because there was a few months of nothing, boring. There wasn't much to talk about. Like it was literally similar. It's going to be a hold. The market's pricing in this, and then they got a whiff of, inflation's gone up, or it's going to go through the roof. And the banks are divided on this right now. So anyone that's certain that the interest rates are going to go up, like you're kidding yourself because CommBank and ANZ have different opinions. Like better than them. Like no one knows what's going on because there's a new data set coming, and that will influence everything. So my whole notion on interest rates is just almost forget about them. Like have a band. If interest rates go up 1%. Or down, does that change your behavior either way? If it does, maybe adjust your personal preference there. But I couldn't give a rat's ass what the interest rates are going to be because it's not going to affect my decision. If they drop, like let's say New Zealand, there's significant drops there. Yeah, they dropped from a commercial rate a year ago of 9% down to like I'm completing a purchase there at the moment. My interest rate's around 5.6, so it's 9% to 5.6. That's a story. 3.6, bank rate to a 4, that's not changing anything. Like we're positively geared on our deals anyway, so it doesn't matter.
Got to think about the news cycle and, the back end of 2025, all the fear mongering, scam mongering around rising interest rates because CPI numbers and all that sort of stuff because not much else happening.
Yeah.
But you look at right now, and we had the unfortunate incidents in Bondi. Subsequent to that, conversations, discussions around, royal commissions into anti-Semitism, all that has absolutely rightfully dominated the news cycle. And then you've also got what's happening with, say, Venezuela and all sort of stuff. There's very, very few interest rate stories out there at the moment, purely because there's other things happening which are probably more pertinent for news coverage right now. So when you see these things coming back into the cycle around fear mongering around, when was the last time you saw a story on housing affordability, right? I haven't seen one of them for quite some time, and the last couple of months there hasn't been a lot of coverage around it. So it'll rear its head again.
You'll see it. Like there was a footy player that did a story on how it costs $58 to buy a steak and have a beer at the pub, and he's had like 1 million views on it. So that's a cost of living type. You're going to see a lot of those stories this year. So cost of living is a big issue in Australia, and it's going to get worse because everything that's happening, like the way the economy is structured, it's not looking good for anyone that's trying to get by and save money. Like that'll be the big story. That'll go through to elections. Like there's no way to really fix it quickly as well. So affordability is your big story. Other than that, property's pretty uneventful.
Yeah. And it'll be affordability conversations as the news cycle starts to normalise quite a lot. So, but your recommendation around interest rates is don't get too absorbed or obsessed with shades of basis points increases left or right, 25, 50 basis points, 75 basis points. It's going to happen. And
put it this way, it's the number one thing I get asked by media to comment on.
Yeah.
They don't really care about what's happening in the industrial market, all the stuff we're talking about. It's too granular. Like this is where the real stuff is. But they just want to talk about interest rates because it does.
It's connected with cost of living. Cost of living is connected with other aspects of the economy.
Yeah. But is it going to affect how you invest? The answer is it should not, unless you invest for the theme. So if the theme is there's a long-term increasing rate environment, then behave differently because that will affect your capital growth, like drivers. If it's like New Zealand, the reason why I love that market, the reason I've literally bought myself is there's been a lot of rate cuts. The market has not priced in those rate cuts. I'm going to have a win on the values. It's almost nothing's guaranteed in life, but I feel like that, or like the locals are still adjusting because they feel like, their liquidity dried up when interest rates were high and they're just starting to get back.
You're a new market entrant. You don't have you don't have a legacy connectivity with that market, right? So you view it as it is, and probably faster, but that's the way it is. So you'll leverage around it. So let's have a chat then around asset classes to target and which ones to avoid. Let's start with targeting. Where are you going to put your dough?
So the ones where I would be buying with confidence is the secondary industrial market, both suburban and regional.
How regional is regional for you? When is it too regional?
Well, look, it could be a 20,000 person town, but it's like 40 minutes up the road from a big one. So you can't generalize too much, but you wouldn't be like, again, some of these really regional areas have got their, a short supply of industrial properties and they're not going to build anymore because no developer's going to risk anything there. So it's cases for cases, but like little towns, like we don't really see any deals out there anyway. Like often tiny towns don't have industrial complexes. You might have one or two by itself and no one's selling those. So why I like it, yields are a bit higher in secondary. Like you'll be getting anywhere from 5.5 to 7.5. You as I said, you could expect 7 to 9% growth in some areas. So it's a capital growth play, that one. I like it because the owner-occupier market's strong under it. So it's tenant dependent for your cash flow, but the valuation is dependent on also the owner-occupier market, which is, in some areas is 10, 20% higher than what we're paying. So you can make money if the vacancy becomes there because an owner will pay a premium for it. So it's different in all different markets. But
so owner-occupiers are pushing up rents in sort of this industrial class.
Yeah, they are. They are. And it's just because of the rent growth scenario. They're a little bit spooked by it. So large format retail. So like we said before, won't cover it too much, but Bunnings, Harvey Norman, zero new supply, 10-year plus leases, just strong fundamentals. And you think if there is a housing boom, these businesses do better. So let's say the government hits their targets and builds all these houses. You've got people selling beds, new TVs, all of that comes out of these large
strata or freehold.
Doesn't matter. Yeah, because remember, we're calculating net yield. So the tenant is paying your strata, which is basically building insurance and common areas, cleaning, and maybe a light pole.
Someone's got to pay that anyway.
Yeah. So it doesn't affect your net figures. And if anything, if it's a big complex, it's like another set of eyes on it. So I don't mind strata at all. Neighbourhood shopping centres, 5 to 15 mil price points though. I think the growth, my prediction there is 5 to 7%. So it's a little bit less than the others just because there's just not much out there with the right yield. So, yields have compressed a lot in the last 12 months. So that's a good one. Child care centres. Now, this is a bit of a stab in the dark, but off the gut, I predict probably 4 to 6% growth for, this is like just growth, not including the rent increases for childcare. Why? Government-backed demographic, there's a tailwind there, there's long leases. There's some really good operators expanding their business models there, buying independents out, rebranding them like G8 and stuff like that, or Good Start. And they're basically just, they have a business multiple advantage. So they might buy it at a 3 times multiple and then whack their corporate private equity stuff all over it. And then they're making really good money. So the businesses are worth motzes in some areas. So yeah, it's a single tenant asset, but there's a business often worth more than the property itself within it because they do make good profit margins in general. General comment, I don't know every deal, but they're expanding quick.
How do they value a childcare centre?
It's just like they got their standard industry multiple as a property management firm would to a accountancy.
Essentially, it's like a subscription type model, right? Because you get them in and get your spot. And
and a lot of them turn profits. This was a couple of years ago. Like, once you hit about 40% occupancy, you turn on a profit as a childcare operator. It might be different now. But basically, you don't need it to be 80, 90% occupancy for that business to do well.
Okay.
It can be quite low in some areas, especially if the rent's lower as well.
So as tenants, they're, if a childcare operator runs a pretty reasonable operation, they should be profitable.
Oh, yeah. And even if they weren't, there are so many of it just selling out and getting franchised and
So there's consolidation. So there's always something like that.
Which is a good sign of the industry.
Just driving around town, you see that still a lot of them getting built, right?
Yeah. So, and then outside that, just the specialties, like I mentioned. So things like cold storage, there's a massive shortage of it in the country. That's basically a warehouse with an expensive fit out. Yeah. It's a big fridge, it might be selling homegrown salads or, yogurts or all the whatever, anything that's in the cold storage part of Coles and Woolies.
How important is DD when you're considering cold storage? Like, is there specialists that can actually look at the refrigeration or freezing system, work it out?
Yeah, they get serviced. Okay. So there's normally a service history. So you talk to that operator, you might get an asset, like a comprehensive building and pest report done where these things can cost 10, 15 grand. If it's a big shed, you'd probably want to get the replacement lifespan calculated for you.
They do get clapped out eventually, right?
Yeah. So, but a lot of the time it's on the tenant as well. So again, huge DD is done on the lease itself. Like who's responsible for maintenance or capital works? What's it worth if there's no shed, no fit out as well? Like the rent might drop 30%, but it could sell at a lower cap rate because people prefer just a standard shed. So there's a lot of nuances to it. Last one is just all those. I'll throw them all into one bucket, like the office where you've got medical, professionals, specialty. I like that at the moment because it's still priced well. Like you can get a good yield.
Regional, suburban?
Both. Yeah. Like sometimes regional's better. Suburban's just more chance of variations in the market happening because it's moving quicker. Sometimes a little stable town where you've got a real estate agent in there and a financial planner and a lawyer and a dentist is the best investment because you're getting at a very high yield. So that's a yield play. Now, what to avoid or be careful of. We talk about what to buy, and I think it's very important to say what I would not be buying. And there's a few. I would not touch secondary office, whether it's B, C, or D grade with 10-foot barge pole because it's like there's a problem there. Like there's no need for people to want to come in to a 1980s fit out and clock on and clock off. It's a dead business model. So, and then the cost to refurb these things is through the roof, and there's a lot of people doing it at the same time. Yeah. So that story is going to get worse before it gets better. So if anyone is presenting secondary office in a CBD, you got to have a very good lease or some kind of like it's half price. You'll get those opportunities though. And then
imagine owner-occupiers would be interested in that, but maybe not for the investment stock.
And then remember, office markets are different. Like Brisbane is fairly strong in some areas, and then, you know, Melbourne's the opposite. So yeah, again, there's nuances. Strip retail, high street, I would not touch too much. This is more like, and again, it's changed. I remember when we first did this podcast, I used Oxford Street in Paddington as an example of a bad area. And like, you know, I drove up and down that street all the time, and it's now just completely changed. It's like there's a whole high-end shopping culture there now. It's pulled a lot of the weakness out of the CBD to there. The vacancy rates have completely vanished.
Very cyclical high street sort of retail.
Right now it's booming there. So there's premiums, vacancy rates are tight. But I still wouldn't buy there because you're paying a premium there now. So, you know, if you're good enough to time that market, you would have made money. But the problem is the same problems. Like if you look at Parramatta Road, it's very hard to get to the shop because you can't stop on a highway. You need to park down an adjacent street. By then, you could have got on your phone and bought whatever you're going to buy online.
Yeah, Parramatta Road's interesting. That's all just got to get converted to strata resi,
which is a more viable use.
Yeah.
So,
what about sort of retail strips in suburban areas?
Well, that almost comes into that neighbourhood shopping centre.
That's different again.
Yeah, like so strips that kind of like highway type. Chuck CBD strips in there as well. Like, you know, just walking here, there's pockets of extreme strength, like the high end stores where they sell the watches and the, you know, the Pradas and Louis Vuitton. Like it's different, but if you go down the wrong street, you're going to see vacancies that have been there for 5 years.
Yeah, I remember I was out St Mary's as an example, maybe 3 years ago, and the whole strip through there. One end of the strip was really vibrant, and the other end of the strip was pretty much everything was empty. At a point in time with the transformation of your railway and all that sort of stuff.
Yeah, the light rail decimated some areas.
Yeah, so like, you know, and you look at these areas where you just go, you know, you look at it and just, that's vibrant and that's not vibrant, and it might only be a couple of 100 meters from each other. So you got to be very careful with where you're.
Yeah. So like if you're looking at that, you just almost got to be a customer and just walk up and down. Like what's the vibe like? Shopping centers, suburban, you can see car parks, you can see national branding tenants. But if you got some random store selling like acai bowls or something like that, like you just got to think, you know, how long has this business been here? What if a competitor, you know, rocks up? You know, that's where the risk is. Number 4, what I would not be touching is hospitality. So pubs and hotels at the moment, unless you're really experienced. There's a few reasons for that. Like things with pubs, like or just nightclubs or whatever in general, it's quite prone to government intervention. So we all know what happened with the one punch, what would they call it? The King hit in lockout laws. So that destroyed King's Cross. That's a different area now. There's complaints where hours get reduced, and they prioritize the complaints over venue success. And then you've got to organize security, and then you're going to keep up with how social media influences business. Like you can create a lot of demand off the back of hype, but if you don't have that hype, you're a nobody sometimes. So even if the venue is good, poker machine reforms are probably going to be a thing in the next few years because there's so much advertising about not being allowed to advertise for gambling, yet it's sort of happening there. So if they reduce the amount of poker machines or create some legislation or tax it more, most of these pubs in Australia would probably go broke. I personally was looking at a pub, didn't have poker machines a few years ago, and I went granular on it. It made money 2 days a week, Friday and Sat, and then outside of that, unless you've got a brilliant restaurant or something like that, it's very hard to turn money over.
Hospitality is a completely different game. Unless you really know what you're doing. There's some people in Australia that really know what they're doing. Most people blow their dough. You know, most restaurants go out of business. Exactly. Most nightclubs and bars go out of business. They might have a moment in the sun, but eventually they fade and they fade quickly.
So true. Like it's quite cyclical. When you're on in that game. But otherwise, it can be a very, very long, dark time where you don't make much money, and then you're dealing with staff that are inconsistent, and then you've got the security risk. And I wouldn't be touching hospitality assets unless it's some, cult classic type thing, which has been around for 40 years. Two more, actually. So development sites, for everything we've been talking about in this podcast, where the economic doesn't stack up against existing stuff. It's too expensive.
So buying land banking, thinking one day I'll develop that?
Yeah, look, if you're an expert developer and you've got your numbers set, there is a niche for you for sure. But the majority don't make money with developing. Like, it's the whole thing. You go to a holiday you go up to Port Macquarie with a couple of mates, you see a little duplex site. Let's go buy that duplex. And then you all chuck 400 or 500 grand into it. And in 5 years' time, you might have turned a profit. Like, it's just a mugs game half the time. They don't know what they're doing. You're up against all those people. But if you
only hear the good stories around development. Most development stories aren't good stories.
And that's why I bring it up, because everyone, it's not so much now, but like when times are good, everyone likes the sexy development story, and they say, "Oh, Rethink, can you help us find a development site out of Badgerys Creek?" Or, I got that probably 1,000 times. And I was like, you've missed the boat. And like, do you really have 10 million available to see that out? And I go, and they said, "Oh yeah, we'll just want a land bank and then offload, like just buy Bitcoin if you're doing that, just flip it for, that's all you're doing, trying to buy low and sell high." Like, they're not going to action it half the time. Yeah. And most people that develop that are novice do it once as well. So, and the last one, just low yielding assets. Like, this is a game. 2026 is about getting value. It's not going to be a crazy market where you can see record growth. There's not much downside in it as well. But if you just drop your pants to get the lowest yielding thing just to get into the market, you've given away the whole point of the investment. You need to get a return. So have your minimum yields. Everyone's got their own. All of the assets, you can ruin the best investment by just paying too much.
So again, to the point, if you're doing it yourself or your buyer's agent recommends lower yielding stuff, you really got to be asking questions.
Just push back on them, because that's it. Like, I know even just from a competitor landscape point of view, like our competitors will, to beat Rethink in the market, they're generally trying to get the clients who are happy with lower yields. The way they do it is say, "Oh, that high yield means low quality," or, they'll just try kind of shit on the deal somehow to sell the fact that you are then going to be conditioned to pay lower yield, because that's quality. That's the whole thing. The higher quality.
So that's a misnomer that quality stock has lower yields.
In general, it will have lower yields, but they're conditioning you to accept lower yield to make their job easier. I'm doing the opposite. It creates a barrier to entry to the industry. It means our job's harder, but we need, like, large format retail. If you said my minimum yield was 4.75%, I'd have a deal with you in the next 3 minutes. It's so easy. But I'm putting the bar high. We need to get like minimum 5.5. It's going to be hard. We're going to miss out on a few. We need to in a good area as well. Like, just set the bar high. And if someone's trying to sell you down all the time, there's got to be a reason for it. Low yielding is perfectly fine if there's upside, if there's, capital growth on its way, like within a year or two, that, in the form of upside as well. But don't just fall for it's quality deal. It's a quality deal. And that's what happens. So they're the assets.
So tell me about New Zealand quickly. What's going on there?
Yeah. So really,
we should do a whole podcast.
I know this deserves a whole one. Yeah. So, that's my last purchase, basically gone unconditional on a deal. So industrial, Christchurch, been a good experience. I'm going to do a little video sort of step by step, but it kind of feels like I'm in Australia. Like, I like, especially because I offload a lot of the admin tasks and that. It's everyone that thinks it's a totally different country when it comes to buying. Yeah, it's a different country, but like the buying process feels like you're buying in South Australia or WA. It doesn't matter. So I think it's the sleeping giant in the whole equation because of the interest rate scenario. It has not filtered through to the market. It feels like 2020. Remember 2020? I can't quite remember exactly what we said, but I knew we were talking about how interest rates versus the yields, it was a little bit out of whack. It was priced well. Like, it's a whole different equation over there, but it's just priced well. So, for example, prime yields in some areas were kind of peaking at 6.85%, and we've seen that completely. Like, some of them have gone to 8% in areas. Well, like Auckland, we were buying deals they're getting valued in 2023 at 4.5%, and you're getting them at 5.8, 6% type yields. It's softened a little bit lately, but like 40% corrections in some area. So that 40% in many areas you might have lost 10% of that growth already because it was a good year, 2025 in some areas, is yet to hit that market. So I don't feel like there's that type of upside anywhere in Australia, for the record.
So for Aussies out in NZ, and maybe a question for you, is it, are you borrowing dough out there, or are you just deploying straight cash?
My interest rates was mid to high fives.
Okay, with a Kiwi-based lender?
I got 2 offers. One was Kiwi Bank, one was ANZ.
Yep.
Kiwi Bank was 6% and ANZ was 5.6, I think.
What, 65% LVR? 70%?
65.
Okay.
So yeah, they're same as Australia.
Same as Australia.
Yeah.
And no issues borrowing there as an Aussie?
No issues. Fundamentals are a bit better. Like Auckland vacancy rates, for example, are 2.8 versus Sydney 4.4 for industrial.
Yeah.
So it's tight in the right areas. I'm forecasting capital growth. Look, it's hard because the markets are so different, but equivalent to the best in Australia. So, that 6 to 9% type across the board.
Did you buy industrial or?
Industrial.
In Christchurch?
Christchurch.
Not worried about earthquakes, not worried about.
Well, you do the check.
Yeah.
So it cleared the test. They're engineered properly. So, if there's another earthquake of that magnitude, they've got a rating system over there. So it's all part of the DD. So we use local lawyers over there. They're completely across it. We've got incredible workers in New Zealand that.
So you've got a good supply chain out there already.
Yeah. We're finding very good quality deals there. Yeah, Kiwis are investing with us. It's mostly Kiwis.
Okay.
So
good.
My only disappointment last year was probably how fearful Aussies were or how closed-minded they were to investing overseas, which I kind of get, but just like, we're here to make money. Like if there's an opportunity there and it's just as easy.
What about sort of tax consequences and compliance? So, how do you get your dough out there? How do you deploy it? What's your responsibilities? We've got to really get into it.
So you got to set up a company there. You got to do all that. Like my plan, full disclosure, is to keep my money there and reinvest it over there. So I plan to go pretty heavy into New Zealand over the next decade. It's a diversity play. It's like, so I've got my own bank accounts there. Like I've got a business there obviously as well. So all the money can cycle and flow and just stay there. It's its own war chest. It's got nothing to do with Australia.
So you've got that completely back to this idea about compartmentalizing stuff. You've got that compartmentalized out there. So you'll keep that isolated.
Yeah. And if I need to bring it back to Australia, which I don't see any world I'd need to do that. Like something terrible would have to happen in Australia for me to do that. Yeah, you would have to pay your tax, and there's structuring ways. You got to have 2 accounts. You got to have one over in New Zealand and your Aussie one.
So you got tax responsibilities in New Zealand. Yeah, everything like that.
Yeah, but remember,
it's just as a company,
there's no capital gains tax and there's no stamp duty.
Yeah,
that alone makes a huge difference. Like Kiwi investors very rarely want to invest in Australia because those two make a huge difference. Like if you're a multimillionaire Kiwi and you can have no capital gains tax and those stamp duty commitments, like you're saving, on 10 mil, you're saving 500-600K in cash. Like just stay over there and invest and get a better yield.
And you can trade as well, right? Because you're not paying
in and out.
Yeah. So there's no capital gains, so you can just trade. There's no stamp duty. You can just trade.
Yeah. So, and plus the yields are a bit better. Now the interest rates are equivalent. Like it's just, the numbers stack. Simple as that. Yeah. The forecast for growth is strong. All the same fundamentals kind of match. Childcare's looks solid there. The office market's a bit weak there. Industrial's strong. There's rent growth. Suburban retail looks good. It all works. They're just like regional versus capital city. All the same things you use in Australia works over there as well. The brands are quite similar. Like the New Zealand economy has the same tenant pool as Australia, basically.
Yeah.
They got their own versions of certain things, but fundamentally, it's the same. It's just smaller. It's a smaller market, so there's just a little bit less going on. It's like dealing with just one state. That's how I look at it.
Yeah, it's a good view. Well, thanks, Scott. Very informative. I think we've set ourselves up for 2026, and we'll no doubt review this in 12 months' time to get a sense for how well we've sort of given a sense for what the coming year looks like. Big plans for Rethink over 2026. No doubt we're going to have a chat about that. Many other things for us to get through, but conscious of the time, mate. Thanks for coming in. Thanks for having me. What's the best way to track you and the crew down? What's the best way to get in touch?
Just Google Rethink Group, Rethink Investing. And I'd like to confirm what we offer this year. We offer a buyer's agent service for commercial, residential. So residential is a big growth focus for us this year. We've got Rethink Capital. So if you want to invest in a syndicate, That's you can get in with minimum 100 grand for that one. That's a good option. We've got the Rethink Wealth, which is plans. Like he's booked out till March at the moment. So that's super popular, almost too popular. But that'll give you the plan on, do you want to sell 2 assets and buy a commercial? Like someone who can legally tell you and map it out with 20 years rather than just a gut. Do that, which is what the industry does. It's proper planning. We've got the financing department doing all the loans for commercial and residential, legal, insurance. Yeah, bit of everything these days. So
there you go.
Yeah,
we'll track them down. Thanks for tuning in, everyone. I hope you enjoyed that. A lot more of this over 2026, and we look forward to joining you as we navigate commercial property investing. Until then, bye-bye.